In this presentation, we will enter an adjusting entry related to an invoice or accounts receivable. In other words, we're going to have an invoice that was entered as after the cutoff date for us in March, and we're going to be doing adjusting entries as of the cutoff date of February. And although the invoice was made in March, the work was done in February. Therefore, we need to make an adjustment, in essence, bringing the accounts receivable and the related sales back into the current month in which the work was done, as well as the cost of goods sold and inventory, so that we are on an accrual basis. We will enter this into QuickBooks Pro 2020, QuickBooks Desktop 2020. Here we are in our Get Great Guitars file. We currently have the Open Windows open. You can open the Open Windows by selecting the View drop-down up top and the Open Windows list. We're going to first take a look at our financial statements. Let's open up our reports up top. We're going to go down to the company and financials and then scroll on down to that balance sheet standard report. Within the balance sheet standard report, we're going to customize the report up top to the left. We're going to tab through this and say we want the starting date to be 01/01/20 to 02/29, or let's say 29/20. That's January through February, February 29th, the end of February being our cutoff date. We're going to say, okay, this is going to be our balance sheet. Let's then open the profit and loss report. We're going to go to the reports drop-down, company and financial. Then we'll open the profit and loss reports, changing the dates from 01/01/20 to 12/31/20. Here's our profit and loss report. Now, what we're going to say here is there's a scenario, and this is quite common depending on the type of industry we have, in that an invoice was entered in the, actually, let's make this ending date. Sorry about that. Let's make this 02/29/20. So the ending date being the cutoff date, January through February 2020. Now, what we're going to say here is that there was an invoice that's going to be entered in March for which the work was done in February. To be on a proper accrual basis, we would need to then adjust February and bring that money or bring that amount back into February. In other words, if we entered an invoice in March, the sales would be in March. They would not be here as of the cutoff date of February 29th. And on an accrual basis, if we did the work in February, we should bring it back. Now, you might say, well, what does it matter? Well, I'm going to have the invoice in March, and so it'll be okay. It'll wash out as of March. And it'll be fine. That's true. And note that it is just a timing difference. So whether or not you want to record a journal entry like this depends on how accurate you want your information to be as of the end of the cutoff date on an accrual basis. It will distort your counting from one month to another month if there's problems with the cutoff bases. And if you want to provide your reports to somebody else that wants the reports on an accrual basis, those timing differences are important. Those are also areas where people actually, might try to manipulate the books somehow by basically having a timing issue of sales being in the wrong period. So it's common for that to happen. Now, when would this commonly happen? If we're like a service type of a company, it may be the case that we do it for bookkeeping, or in our case, we have those guitar lessons. It might be the case that we count all the guitar lessons throughout the time period, throughout the month, but we don't actually accumulate them and invoice the client until the end of the month or 2 weeks later or something like that. That means that the invoice is what drives for QuickBooks when the sales are going to be recorded. Because Invoice uses the invoice does not mean that the invoice is the time when we actually earned the money. It's just when QuickBooks is the only thing QuickBooks can tie to in terms of a form to be correct. If we enter the invoice way after the time period in which we did the work, then the invoice is not going to be the proper time period in which the revenue should be entered. It should be entered, it should be added when we did the work according to the accrual basis of accounting. Now, if we sell things or ship things, then we'll have to think about when the actual shipping took place. So if there was an instance in which we recorded the invoice after the goods were shipped, for example, you would think then that we should be recording the invoice when the goods went out. That's when we completed the work, and that's when you'd have to make this type of adjustment. We're going to make this adjustment for one that does have inventory, because that's going to be more complex. We'll have to do with cost of goods sold and inventory. Same thing would apply to if we're a service company, although we won't have the inventory component to it. To think about this, we're actually going to enter the invoice first. I'm going to enter an invoice for March. we're gonna enter it into March, and then think about how we would bring it back to February. Let's think about that. We're gonna go to the Home tab. We're gonna go to the Create Invoice, and we're gonna create an invoice for Sam, the Guitar Man, and just as we have done in the past. But we're gonna create this invoice after the cutoff date in March 2nd. So for whatever reason, we didn't enter the invoice till March 2nd, and it's been determined that we should have entered it, or we have earned it, or we have earned the revenue in February. So we're going to tab through this and say that it's going to be, the item is going to be an ELP, quantity will be 1, and there's going to be our transactions as we have seen before. So what's this going to do? As we've seen before, the invoice means it's going to increase accounts receivable. The accounts receivable goes up by the 525. The other side's going to go to sales, but sales is only going to increase by the 500. The difference is going to be the 25. It goes to a payable account. That'll be the sales tax payable. Then we also have the cost of goods sold that is going to be increased, and the inventory, which is going to be decreased. So we're going to save and close this. Then we're going to go back to our profit and loss. Let's go to the profit and loss, and let's change the dates up top, and let's just look at March. So I'm going to say let's say 03/01/20 to 03, let's just say 15/20. And now we've got, and after the cutoff date now in March, that one invoice that is now in March. There's the sales amount, here's the cost of goods sold amount. Now, we're going to say that that invoice was created after the cutoff date. We need to pull it back into the current period. Now, you might think, well, we could go in there and just adjust the date. It being QuickBooks, we could do that. But let's say that the invoice might be tied to other things, and we don't want to adjust the invoice. What we're going to do is adjust it with an adjusting entry. So we're going to enter basically an adjusting entry to pull back the revenue to the current time period. And that's usually the most proper thing to do. If it was an error of date and you just caught it right now, you might want to just adjust the date. But if it's tying to something out, or if it's in there as some reason as to why the books are in there at the date that it's been recorded, then you probably want to keep the invoice in there and then just simply make the adjusting entry to make the financial statements correct. Keep with your normal invoicing system. Don't adjust the invoicing system, but make an adjusting entry to be on an accrual basis. So then we're going to go to the balance sheet, and let's do the same thing here. If we were to keep the balance sheet as of 03/15/20, then 03/15/20, then we'll see the other side is going to be an accounts receivable. Double clicking accounts receivable and changing the dates to 01/01/20. We'll then see down below there's the 525. Closing this back out, and we see the inventory will be affected. Double clicking on the inventory and changing the dates to 01/01/20. We'll see that the inventory is affected here with the 400 on 3/2, and then we also see that the payable sales tax payable down here will be affected as well. So I won't go into that now. So then how are we going to make the adjusting entry? Now you've seen that this one is going to affect multiple different accounts, so I can't really avoid the journal entry from this one. So what we're going to do is actually enter a journal entry like we normally would. We're not going to use a register. We're going to go to the company up top. We're going to go to the make journal entry. And so we're going to make a journal entry, and we're going to pull it back in. So we're going to pull it back into the cutoff date before the cutoff date. So we're going to make it as of 02/28/20. Now the way to do this, I would think about what the actual invoice does. Record the journal entry related to the invoice first, and then think about how you would reverse it. So for example, if I went back to the profit and loss and actually opened up the invoice and said, okay, let's find that invoice, let's open it up. What's going to be the journal entry related to this? Let's think about it in debits and credits, and then reverse those debits and credits and then we'll record those debits and credits, and then we'll have to reverse them for when we do the reversing entry, which we'll talk about later. So I'm going to go back into here. What are going to be the debits and credits? Remember that AR is going to be increasing. So we're going to say accounts receivable is going to go up with a debit of 525. And then sales, or the revenue, is going to go up in the credit direction by the 500. And the difference is going to sales tax payable. And I'm going to call that the negative sum of these items. I'm going to highlight this and change the formatting of it because I like to see brackets around there. So we'll make the brackets go around there because that's what I would prefer to see. Let's go to currency, brackets, no dollar, no dollar. All right, there we go. And then the other side is going to be cost of goods sold, the 400, and then the inventory is going to be 400. Now you want to really write this down because then you're going to have to enter it. And once we enter this, you'll note, you might say, hey, well then we're going to enter it 2 times. Like once it gets to March, when we enter now we're going to have the invoice in there twice. And that's right. But we want to get it right as of February, and then we'll reverse it. So we'll get it right as of now, as of the cutoff date, and then we'll reverse it. That way we don't have to touch the original invoice. We can make the financial statements correct on an accrual basis as of the cutoff date, and then reverse it. So especially when you think of the reversing entry, you want to really write this down so that then you can reverse it, because reversing it is even less natural than writing the debits and credits out here, because we're not used to, reversing the entry. Okay, so then if we go back over here and we're going to go to our journal entry, we're going to make it as of 2/28. So we're going to say accounts receivable is going to be the debit of the 525. Now we're going to make it an adjusting entry. I'll just put adjusting. Now we have to have a name here whenever you deal with the accounts receivable, because it won't let you post it, because the accounts receivable needs supporting documents so it can tell you who owes you the money. It has to have the supporting document to make that supporting schedule. So we got to put, this was for Sam, the guitar man. And then we had the sales, which was merchandise sales, increased by the 525. I don't think we need a name there. Then we have the sales tax payable. It's going, actually, this should be 500. Sales tax payable will be the 25. And we'll put the adjusting entry in all these. And then we have the second basically journal entry, which is cost of goods sold at the 400. And then the inventory. And that's going to be the 400. So adjusting, and this is going to be an adjusting entry. Now note also that this is going to throw off basically our accounting for inventory during this time period too, because we haven't assigned it to an inventory item. But that's okay, because we're going to reverse it, and then it'll be back to where we want it to be. So let's check that out. We're going to say save and close, see what happens. And you must specify vendor for the sales tax. So sales tax, this one needs a vendor because it's going to be tracked in the payable by vendor as well. And that was going to be to the New York tax collector. Okay, let's try it again. Now we'll say save and close. And there we have it. I'm going to close this back out. And then if we go to the profit and loss, and we make this as of before the cutoff date. So what we did is we pulled this revenue back before the cutoff date. So we're going to go then to 01/01/20 to 02/28/20. Then if we go back into the merchandise sales, double click on it, we see the adjusting entry down here. So there's our adjusting entry, increase in the sales for the invoice that the work was done here, but the invoice wasn't entered until after the cutoff date. Double clicking on that, there's our journal entry. If we double click on that, we get to our debits and credits. Closing this back out, closing this back out, closing this back out. We also have the cost of goods sold that is included here. Double clicking on that, we see down here we have the adjusting entry related to the cost of goods sold. And if we double click on that, we have our adjusting entry. Double clicking on that, there we have it. So now we've included those items in the timing accounts, closing this back out, closing this back out. If we take a look at the balance sheet as of the cutoff date, and I'll change the dates up top to 01/01/20 to 02/29/20. Okay. We then go up to the accounts receivable, double clicking here. Scrolling down, we see the 525. Then we're going to scroll back out and we see on the other side is going to be the inventory. Double clicking on that. We've got the 400. on the adjusting entry and the sales tax. Scrolling down to the sales tax, we've got the 25 in the adjusting entry. Closing this back out, you'll also note this is why we needed to make the adjustment, because the accounts receivable here needs to tie out to the subledger. Let's take a look at that. If we go to the reports up top, we go to the customers and receivables, then we're going to go to the customer balance detail report. Now I'm going to change the dates up top from 01/01/20 to 02/29/20 to get to that cutoff date. If we scroll down to the bottom, we'll see that we're at the 10,974. That should tie out to the balance sheet 10,974. Back to the customer balance detail in the open windows. Note that if we go into Sam the Guitar Man, we have that 525 not being an invoice, not being a payment, but being the journal entry. If we then take a look at the second account, the one that's going to be off now, the inventory, because we added to inventory and we didn't add it in the detail ledger, let's take a look at that. Reports up top, we're going to go to the inventory. We're going to go to the inventory valuation summary. Let's make this as of, let's make it as of 02/29/20. We have the, let's take out the calculator here. The cost of 1712 minus, and if we go back to the balance sheet, we have the amount of minus the 1312, the difference being 400. So you'll note that we didn't add the inventory here, and that's going to be an issue, but that's okay because we'll reverse this as of March. Now also note that if you then take this out through March, you're going to see a problem, right? If I go to the reports up top, and then I say let's take this out to March 10th, let's say, then we're going to have some duplicates, right? Because if I double click the accounts receivable, we then see that we have the invoice on the journal entry and then the original invoice, which was entered in March. So as of March 2nd, when the second journal entry was entered, we have now entered it twice. So we solved the problem of being okay here, but now we've entered it 2 times. That's okay because we're going to have reversing entries, and we're going to reverse the entry. So this was just an adjustment just to make it correct on an accrual basis so that we didn't have to mess up the system we had for normal invoicing processing. Then we'll simply reverse it right after this day so we're back to our normal system. So I'm going to close this back out. Obviously the same thing would be the case for the inventory. And there's the 2 400s, and therefore we're going to reverse this adjusting entry back out as of March, which will put us back in place where we should be with just the single 400 here. Closing this back out, you'll see the same problem in the profit and loss report. If we change the profit and loss report to sometime in March, let's go to March 10th again. Then within the merchandise inventory, if we were to double click on it, you'll see that we have the 500 in the journal entry, the adjusting entry, and then the invoice. So that means that we've doubled it up here as of both months. Therefore, we're going to have to do an adjusting entry or a reversing entry, reversing this one. So we will do that in the future. We're going to close this back out. And then the other side, of course, being cost of goods sold, we'll have the same problem there. There's the journal entry. Here's the invoice. We have it doubled up. We're going to have to do the reversing entry. So we will therefore do a reversing entry, which will actually mirror this one completely, and then reverse it as of March 1st. Okay, let's take a look at our numbers. We're going to go to the reports up top. We're going to go to the accounting and taxes. Take a look at the trial balance. We're going to change the report to 01/01/20 to 02/29/20. Take a look at the numbers, see if they tie out. If they do, great. If they don't, check the dates and see if it's a date thing. Then see if you can fix it. It's great practice to do so. If you would like to push forward and there's a problem with it in any way, or you'd like to jump to the forward part of the problem, we will have backup files which will allow you to jump forward within the problem with the same numbers we will be working within it.